I'm endlessly fascinated and curious about the world around us, about business, about politics, about the arts, about culture, developments, social issues, and the people. Most importantly, about the people that are shaping our future. Every night, I get the opportunity to have conversations, to dive into conversations with thought leaders, with change makers, entrepreneurs, politicians, and everyday heroes who unpack the ideas and stories that I think matter to all of us. What's the future of our economy? What's the future of our country? How do we build stronger communities? What can we learn from music, theater, sports, politics, the arts? How does policy shape our real lives? What does leadership look like, real leadership in today's environment? If it's interesting and relevant and topical and we're talking about it, you'll hear about it here at 6 o'clock on the Brian Crombie Radio Hour. I want to have real conversations, in-depth conversations. These are ideas we're sharing. This is the Brian Crombie Radio Hour. Thanks for joining me. Good evening, everyone, and welcome to the Brian Crombie Radio Hour. So I run into a very impressive gentleman recently. Devon Cranson is his name. He's the head of, founder of, CEO of Cranson Capital. Devon Cranson is the founder, president of Cranson Capital. It's a Toronto-based exempt market dealer that's raised more than $300 million in equity capital from accredited investors for real estate development projects across Ontario. I've been to a couple of investor sessions that he has held about different interesting projects in around the Greater Toronto Area in Niagara, and we ran into each other recently at the real estate forum that took place last week, and I found a lot of the things that he's been saying over the course of the last 6 months, 9 months, really were echoed at the real estate forum. And so I thought it'd be really interesting to check in with him about what he's seen, what he's building, what he's planning on building, and what his forecast is for the real estate market in the Greater Toronto Area. Devon Cranson, welcome to the show, sir.
Thank you very much. Appreciate you having me on today.
It's my pleasure. So tell me, what are you building right now? What are you thinking about? Are you positive about the market or negative about the market?
Well, I would say that I'm kind of in a mixed position because we have 27 active projects, and I'm seeing what's going on in the condo market and even in low rise, and the challenges that people are having closing on purchases they made a few years ago, which leads us to where we are in the market today, is that if people aren't closing on their condo purchases that they made in 21 and 22 in pre-construction, they're not making any more pre-construction purchases than they didn't in 23 and 24 and 25. So to me, it's pretty obvious that without the pre-con investors, we have a problem with starts. We don't have new housing being built. And we're going to have a supply gap in 3 years, which was echoed at the real estate forum, that the lack of starts in 24 and 25 are going to lead to a bigger housing crisis in 28, 29, and 2030. So at Cranson Capital, our focus has been, what can we actually get done? What can we do now? What can we go in the ground with in 26? And the answer is mid-rise purpose-built rental, where we can get in the ground while construction costs are less or moderated, and be finishing in 28, 29, 30 when we expect to see that big supply gap. So we're really focused on purpose-built rental in Southern Ontario right now.
Okay, well, that's great. So let's break this into pieces if we could, based on your experience. So first of all, the supply gap. We see cranes all around Toronto still. We see, these high-rise towers being built that are 80, 90, even 100 stories tall. And they're still being built. What was said at the conference is there was 125,000 condos that were either unsold or under construction. And so we've got a huge amount of supply still coming to the marketplace, correct?
Yeah, well, that's true. 2025 is the biggest year ever for new supply coming on stream. There's going to be some more in 2026, not more than 25, but still a fair amount. And that's why we're seeing today that rents are dropping and values are dropping, because we have a lot of supply coming on stream today. Is it the right supply? I don't necessarily think so. I think we built 2 small units, and it's being reflected in the fact that people are not closing on their units, and developers are having challenges at the finish line, and then buyers don't want to close. They can't get their unit to get the same appraised value that they purchased it at. So there's a big problem today in the market, and I think it confuses a lot of people because, rents are dropping. Why would I invest in rental? But the real thing today is to start thinking about the future. And housing takes 3 to 4 years to deliver. So, yes, we have a huge amount of supply on market today. But we also had a record number of absorption of leases being signed in the last quarter. So yes, there's a lot coming on, and yes, the prices are lower, but they're being absorbed. And we're not expecting that they're going to get absorbed super fast, but we do think that by 27, all of the supply that's come on in 25 and 26 will get absorbed. So we think we'll be back into a situation where we don't have this overhang of supply anymore by 2028.
So some of the comments were that anyone that is planning on rental rate increases, is living in fantasy land, and that even flat might be optimistic. That 26 and 27 rent rates might still go down. They've gone down 5-10% in the last 6-9 months or so. But then hopefully there'll be some increases in 2028, 2029. What are you projecting?
Yeah, that's exactly the kind of message that we're projecting and we're seeing. And we don't make this stuff up. For all of our purpose-built rental projects, we make the developer do a market study, and generally CoStar Analytics is the main group that we use. And they look at, inventory that's coming, that's under construction now in each market and when it's going to finish. And they come up with assumptions for absorption. And they help us determine what the rent rates are going to be in 2028. And I do think that they're going to be higher than they are today, but marginally higher, because I do expect that in 26 you'll see rents drop. I don't know that that'll continue into 27. I think they'll probably stabilize in 27 and then start to go back up again in 2028.
So we've got this huge amount of absorption, this huge increase in supply. We got to work through it, but because no one's building today, we're going to have supply constraints in the market in 28, 29. That's what you're betting on?
Yeah, and I think the numbers show it. I mean, we're delivering 30,000 units in 25. We were in that 25 to 30,000 units in the GTA for the last few years. And then housing starts, I believe in 24 were less than 6,000. So 25 is probably going to be similar. If you used to build 30,000 a year and now you're building 5 or 6,000 a year, unless demand completely disappears, you're going to have a problem in a few years. And we know that we were 3 years behind on housing formation before the big increase in immigration in 2024. So we were behind. We weren't building enough. We continually weren't building enough. Then we had this big population spike. Now we're trying to correct that population spike. I heard someone at the forum make the comment that 400,000 people who are here will not get their visas renewed. I don't think that means they leave. I don't think we have the same system in the US that goes and chases people down and kicks them out. So obviously some will leave, but I don't think we're going to have a retraction in population like some people are suggesting. I think that it's going to be somewhat flat probably for 26, but we need people long term. So all governments have recognized that we have an aging population and we're not having as many babies as we need to. And in order to sustain the Canadian, the environment that we have, the society that we have, we need to have more people coming into the country. So yeah, we're going to slow that down. Yeah, we're going to improve our immigration policy and probably try to get the right people coming. But we need to build housing for the people that are here right now and the people that will start coming again in 28, 29 and forward.
So you're not worried about demand. People have commented about as you mentioned, immigration, foreign students that have been reduced dramatically. Brampton, I'm told, housing is down significantly, mainly because of the restriction on foreign students that were living in basement apartments. And so a whole bunch of people that had built homes and bought homes in Brampton, counting that they were going to be able to lease to foreign students, aren't able to, and so therefore housing prices are down. So clearly, one part of the immigration system is changed dramatically. People are talking about out-migration, going to people moving out of the Greater Toronto Area, moving to Calgary and Alberta for affordability reasons and job reasons. Youth unemployment is 15 or 18%. People are talking about even with rental price reductions, Toronto is relatively unaffordable. So, given all of that, you're still confident that demand's going to be strong in the future years.
Yeah, I still believe in Toronto. I do think that we saw when it was really bad affordability wise, people moving to Calgary, but I don't think that that's going to be sustained. I don't think that the jobs are there. And I think that the fact that a lot of people started to go caused the prices to go up a little bit there, and the prices here have come down. So I think that gap is filling in a little bit naturally right now. But ultimately, people are going to go where the income is. And I believe that, I've heard this story before that there's a guy who worked at one of the big banks, and he worked in Toronto, and he had, X for his salary, and they asked him to go out west, and he took it and he went out west. But there was a ceiling. He couldn't get past a certain number in salary working at the bank out west. So after a few years, he came back. It's just fact that the higher paying jobs in the banking sector are in Toronto, not out west. And I think that's, normal in lots of industries, especially in some of the growth areas like technology and AI. I think Toronto and Southern Ontario have a lot of the higher paying jobs. And so, I think there's two things. I think it's one is the income, but then it's also where people are comfortable. It depends where they're coming from. But we know that Toronto is kind of the melting pot where every culture has established a little bit of a community in Toronto. And it's not the case in other places. So for years we heard the immigration policy was, you got accepted and they told you had to go to Saskatchewan or somewhere else. And after 2 or 3 or 4 years in that province, if you didn't establish yourself, you moved to Toronto because that's where people from your culture already were. And that's just, Toronto is a big draw for people from all over the world for both the cultural impact that they have because they can find people from wherever they're from in Toronto. And then also it's where the jobs are and where the income is. And affordability is an issue, but we're working on that. And I also think that a big part of the problems in Toronto have been transit and, traffic people complain about. And I think that yesterday we finally opened the Finch LRT. So, some transit stuff is working. Hopefully the Eglinton LRT will come soon. And it just opens up new communities. Like just on the Eglinton line, there's going to be a whole bunch of new housing that's going to come in Scarborough that's going to be more connected to the city. And that housing might not come for 4 or 5 or 6 years, but it is going to change the way, the places that people live in the city. And I would assume that if you live in Scarborough in the Golden Mile, for example, it should be more affordable than downtown Toronto. So I think that's a big part of it is building in places in Toronto where you can actually build more affordable housing for people.
So I don't understand something, sir. Maybe you can explain it to me, because frankly, I agree with most, if not everything you've said, which is that supply appears to have been huge in the last couple of years, but based on starts, it looks like it's going to come down dramatically in the latter part of this decade. And demand, while maybe has some question marks around it, is still going to stay strong. Toronto is still the center of business and culture, frankly, for Canada. So if that's true, and you're confident about it, and frankly, at the forum, lots of people, the real estate forum, lots of people, particularly the closing panel, was incredibly positive about exactly what you've just described. Won't everyone do exactly what you're doing? And won't everyone start building again? And won't we not have that supply constraint? Won't we just end up having a whole bunch of smart developers all start building again? And then we'll not have a supply constraint. We'll, in fact, have oversupply.
Yeah, that's a great kind of analysis and question. I don't think everything is feasible. So we have a couple of projects that are meant for high rise, two towers, 40 plus stories, and we can't get them to pencil as rental. I think that when builders had things zoned with big underground parking lots, I think those are too expensive to build right now. And so, if we see projects where there's more than two stories underground, it's just not feasible to build in this environment. It may change in the future, or people will just realize that we aren't going to build around the car anymore. But obviously, you have to be near transit to do that. Another big part of it is a lot of the stuff that's been zoned is for 40 plus stories. And I personally don't love that in the rental model, mainly because it takes a lot longer to build and a lot longer to absorb. And one of the, I think, keys to the rental model is getting through it quickly, getting into the ground. And being built in 2.5, 3 years is really ideal. We don't want to have projects where you take a couple years to fight over the zoning, and then even if it's zoned already, have to take 4 years to build. And then, if you're absorbing 500 units in a new building, that's going to take more than a year. And that can kill your pro forma as well. Now, you see a few people doing it. Some of the big players where they have pension money and their return profile is a lot lower and longer time horizon. I think they could actually go ahead and do it. But a lot of those institutional investors are on the sidelines because they have so many projects that they're in already and they're not putting new capital out. So I think we're seeing more entrepreneurial builders, the ones who are being opportunistic in this market, who see that glaring hole and can fill it. And I think the key is to fill it with mid-rises. And I don't know that, you're going to do a ton of 100-unit buildings are going to get you to 30,000. So with the absence of the 500, 600-unit projects, I don't think you'll get to oversupply. One of the things that I keep hearing people talk about, and they call us all the time about, is these multiplexes. And great that a lot of people want to do them. I think people need to beware of the HST issue. We have HST exemption for purpose-built rentals, 10 units and up. But if you can make it work even with the HST on the multiplex, great. But how many multiplexes does it take to replace a 600-unit building? So, yeah, we can build lots of multiplexes. Yeah, we can build lots of mid-rise. But without the 40-story towers, we're not going to get to 25,000 units a year. And I just don't see the big stuff being feasible yet. Now, that could change if the government wanted it to. If they want to see those big towers come back, they could do something on the development charges. They could do something on HST for all pre-con investors. But I don't think that's the government's goal. I think that their goal is to try to stimulate purpose-built rental and not necessarily the larger projects.
Fascinating. We're going to take a break for some messages and come back in just 2 minutes with Devon Cranson of Cranson Capital. We're going to hear a little bit about Cranson Capital. We're going to hear a little bit about his projects. And then I'm going to want to come back to this concept of what is purpose-built rental, why mid-rise, and what he sees in the marketplace, everyone. This is going to be an interesting conversation for people interested in the real estate development industry in the Greater Toronto Area today. Stay with us. Back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour. We're talking about the real estate market, particularly the real estate development market in the Greater Toronto Area today with Devon Cranson. He's the founder and president of Cranson Capital. It's a Toronto-based exempt market dealer that has raised more than $300 million in equity capital from accredited investors for real estate development projects. Devon, you are the director or trustee of 27 active development projects, I understand, representing over $3 billion in assets under development. Wow. That's a huge investment. Tell me a little bit about your background, if you could, and how and why you launched Cranson Capital, and why you're focused on the real estate development industry for accredited investors investing through an exempt market dealer. So it's private capital investing in private deals, I understand.
Yeah, exactly. And so I could take you back, I guess, the entire journey. Entrepreneurial from a young age, started my first business when I was 13 in eighth grade. Ran that through high school and into university.
You started a business in the eighth grade? You're one of those nerds.
Yeah, it definitely was very business focused in an early age. It was a fun business based on sports, so it was more something like a hobby that turned into a little more, and peaked at about 500,000 in revenue while I was in early age university. But I then ended up getting recruited by one of the banks, and after university, I sold my business and went into the banking world, and I only lasted 4 years working for someone else, and knew I had to get back on my own. And in 2006, I started Cranson Capital as a corporate finance advisory business. So for the first 5 years of the business, I was advising entrepreneurs on debt and equity and M&A, and really gained a ton of experience. In the bank, I gained a ton of experience, but sitting with entrepreneurs and advising them about their business was huge for me. And at the same time as I started my business, I went back to school and did my CMA. So I'm a certified management accountant. So I've got some credibility on the numbers as well in my background. And then in 2011, one of the big real estate developers came to me, and the rules at the Ontario Security Commission had just changed, and they had came out with the exempt market dealer designation. And he was looking for someone to raise money for his projects. And so we did a deal in 2011 where he invested in Cranson Capital. We were already doing a little bit of equity and we were doing some mortgage work, so I knew a little bit about real estate, but he really taught me the business. And for the first couple of years, we really just did their projects, a couple of mezz capital raises, and then some equity. And it was 2013, 2014, great years to be investing in real estate development. And then in 2015, we decided that we would expand and start doing some other stuff. We did a couple of tech deals that didn't go as well as we would have hoped. We did a medical office REIT, we did some seniors housing, some student housing, started to expand into other things, and then started working with other developers on their development projects. So really from 2016 on, we've been somewhat focused on development. And we've done low rise, high rise, purpose built rental, townhouse projects. We've done land deals. So really across the board. I'm still on the board of the seniors housing business in Alberta. We have a platform about 800 beds. And so I'm also on the board of a publicly traded lending business that lends to real estate developers. We're not actively lending anymore, but we had a few loans that we did, and now we're just waiting to wind those down and see what's next. But yeah,
Sounds exciting. Can you explain to everyone what is an exempt market dealer and what is an accredited investor?
Yeah, great question. So an exempt market dealer is basically someone who is licensed to sell investments that don't need a prospectus. And so we generally raise capital for limited partnerships or mutual fund trusts or REIT structures that are private. We can do some public under the exempt market dealer license, but we kind of stay away from that and focus on private. And our target audience is accredited investors. Exempt market dealers can sell to more than just accredited investors. They have what's called the offering memorandum exemption in Ontario, which opens up the pool wider. But we've decided to focus on accredited investors. And accredited investors are an income of 200K. They have to their incomes. They can also
Sorry, what's an accredited investor again, please?
So an accredit a few different ways. So the first and most common one is as income. If they have 200K of income over the last 2 years, then they qualify as accredited. If they combine with their spouse and it's 300K over the last each year for the last 2 years, then they're accredited. They also can be considered accredited based on financial assets. So 1 million in financial assets combined, or if it's total assets, they want to include the real estate assets, it's 5 million. So those are really the three main ways to qualify as accredited investor. There are other little ones, like if you're registered as a dealing representative, as an example, you're considered accredited. But the three that I mentioned are the main ones that most people qualify under.
And why focus on private investors and private deals rather than going public? We heard at the real estate forum that the REIT market is back, so why not be doing public deals?
Yeah, I don't mind the public market, but I think that there's a lot of volatility and fluctuations. And yeah, today the REIT market is back, but sometimes the public real estate will trade below their NAV. And just because of market conditions. So that's one of the reasons why, we like to focus on private, is because your value is based on the actual real estate value. But really the real thing is that public markets don't do well for development. So you don't see many real estate developers on the public markets. Development generally is done privately because there's no quarterly reports that show income growth or anything like that. So basically, in a development deal, you put your head down, you put your money in, and you put your head down for 3-4 years while you're building. You don't have, performance metrics. I guess you can look at your costing and see how you're doing against budget, but public markets have never done well for. There's been a couple, I think, developers who tried in the US. I think there are some, but in Canada, we really don't have the real estate developers going public because of the development aspect. And what you see in places like seniors housing, you see the seniors guys provide developers with like mezz financing and other things. So they're locked into the development asset, but at least they still have cash flow on the financing that they've given them. And then they have the right to buy it when it's finished. Rarely do you see them actually buy dirt and develop. So I think that in the private markets, you have this opportunity to be a developer. In the rental space, when you finish and you're cash flowing, by all means, it's an opportunity to go public. You just need to have the right scale, or you need to sell your building to a public operator. But there's also great examples of private REITs who have done well and don't have the public market NAV fluctuations, and have paid distributions, since inception, and investors have been very happy with those. So I think there's a good opportunity in the rental space to either go public or stay private. But for sure, the development space, public markets are tough for developers.
You've got 27 active development projects, over $3 billion in assets. Tell us a little bit about them. Are they all in the Greater Toronto Area or in Ontario? Are they all mid-rise the way you've talked about? Do you have any towers in your development? Give us a little description if you could.
Yeah, it's all over. I mean, it started more than 10 years ago. So one Yorkville is an example of a 58-story condo tower that we're actually finished now. We haven't wound down the trust, so I'm still a trustee there, but that's an example of a condo tower that we did. We just actually finished a townhouse project in Scarborough called the Huntingdale Towns. It was 81 towns. They're more affordable type townhouses in Scarborough. So we're doing some of that. We have a low-rise project in Richmond Hill called the King Road Estates. We have a bunch of sites where we've bought to take through the development process. One example is Don Mills in Eglinton. We have the old OFL building. It's on Gervais. Today it's an office building, but in the future it's going to be a mixed use office residential with a lot more density, because we have both subway lines are going to be at Don Mills and Eglinton one day. So we're all over the city in terms of we've got a project in Oakville. We have a couple in Pickering, as I mentioned, Richmond Hill. We have Markham Stouffville. The majority of our stuff is in Toronto, some downtown, some midtown, and some even in North York. So
if people want to check out Cranson Capital, do you have a website they should go to?
Absolutely. www.cransoncapital.com. And we're also on social media, on Instagram at Cranson_capital. We have a YouTube channel and TikTok and X and Facebook, and LinkedIn is actually probably the place that we have our biggest following. So lots of places that people can see about our projects and read about us.
Excellent. We're going to take a break for some messages and come back. I'm going to focus back in again on this mid-rise versus tower issue, and why Devon is so confident that the real estate market is coming back. Stay with us, everyone. Back in 2 minutes with Devon Cranson of Cranson Capital and a description of his assessment of the real estate market in the Greater Toronto Area today. Stay with us. Back in 2. Welcome back, everyone, to the Brian Crombie Radio Hour. We've got Devon Cranson. He is the founder and president of Cranson Capital. It is a Toronto-based exact market dealer that's raising equity money to invest in the real estate development business in the Greater Toronto Area and across Southern Ontario, it looks like. Devon, I got to ask you, you mentioned that you've got this site at the corner of Don Mills and Eglinton, I think you said, that's a mixed-use development, a tower site. It's going to be the intersection of the Eglinton LRT as well as the new Ontario line. What are you going to build there? A mid-rise or a tower? And when and how do you think about that development?
So that project was one where we invested as a development investor, not to actually build. So our plan was to take it through the zoning process and then to sell it to someone else. Today, the land market is very soft, so we wouldn't be selling it right now unless somebody came and made a great offer. But we're also not done on the zoning work. So we think that we'll finish the rezoning in 26. And it's not a mid-rise site, it's a high-rise site. And I think that we're going to be patient on that site until the high-rise market comes back. It may mean that we try to make something happen in 27 or 28. But it doesn't, our intent there is not to actually be the developer. Our intent is to take it through zoning and sell it to someone else or partner with someone else who would build, 900,000 square feet on a site like that.
So tower site would be what? 50 stories, 60 stories?
I guess they're still in the zoning process, so I don't want to kind of give it away. But what I believe is that that whole area is going to be more than 40 stories, and there's going to be a lot of towers that are going to come there. And it makes a lot of sense just because we're going to have 2 subway lines, and you can already see the crosstown on the other side of Don Mills already has some towers that have gone up, and there's just going to be a whole new community built there. So, in the current environment, it's going to take some time for everybody there to get moving. But at the end of the day, I think it's one of the best sites in the city. I think if you look at Don Mills and Eglinton in 10 years, hopefully the Ontario line will be working by then and the Eglinton LRT. But it's going to be a hotbed because everything was kind of planned and new, and there'll be amenities and everything that's needed for a full community on transit. So I'm pretty excited to be part of projects like that. It's really about city building there, and I think we can be a part of something that has a lasting impact on the city of Toronto.
Now, what you said a couple of minutes ago in our first segment is that the pre-construction market is not alive today. Do you need the pre-construction condo market to come back to build those towers, or do you think you can build them as purpose-built rental?
I don't know. We're not intending to build that site. So I do think that it would be an attractive site for institutional investors to have mixed use office and purpose-built rental, maybe 1 tower condo, 1 tower rental, something along those lines. But obviously, if you have to pre-sell, that market's dead. So
Dead. That market's dead.
that market is dead. I shouldn't say
Why?
dead. It's not
Why is that
completely
market
dead.
dead?
It's not completely dead. The investors who were buying 500 square foot units, expecting them to go up in value through the development phase and rent them out after a positive cash flow has disappeared. We are doing some, I should give a shout out to our project in Forest Hill, where we're building ultra luxury right in the Forest Hill Village, probably the most high-end condo that exists in Toronto. It's going to be 16 units. I think the average size is over 3,000 square feet. They're going to start at like $5 million. That market
Okay, but
is there.
16 units over, a
8
couple
stories.
thousand square feet is the opposite of what you're describing in a 50 or 60 story building, correct?
Yeah. So that's why I'm trying to say that in Forest Hill, the ultra luxury market, I believe, is still there, and you can sell that in pre-construction because they're end users that are buying it. In a 50-story tower, you don't have that many enough end users buying to sell 70% of the building in pre-construction. So I think we're going to see, some condos get moving because they're end user focused, and they can get people to buy in pre-construction who actually want to move in, not try to make it an investment. So those projects will still be feasible in the short term. I think the long term, I don't know what the answer is. I don't have the crystal ball, but I think that the market needs to change. We have a two-tower project in the Vaughan Metropolitan Center, and we're waiting to see what happens. Can we get the pricing low enough on those towers to bring investors back, where their units could actually cash flow when they're finished? Doesn't seem feasible today, but like I said earlier, if we got rid of HST and we got rid of development charges and we see construction costs continue to come down, maybe that comes back. I just don't think it's going to happen soon and without some significant government support. And so we've heard about other concepts like, will developers start building on spec? I don't know. The reason why we didn't have purpose-built rental for 20 something years is because the developers didn't want to put down 25, 30% equity and build on spec. And so if you don't have your pre-sales, will the banks give you 85% on a condo? I doubt it. So if you don't have the pre-sales, the condo developers, ones who want to build for sale, are going to have to come up with a lot more equity, and then their returns aren't going to be as good. So it's kind of like the reverse of, in 2015, 2016, we really wanted to build a rental building, and we looked everywhere at sites, and we couldn't make one work. You could put down 10 or 15% equity and build a condo, but to build a rental, you had to put down 25% equity. And it just never made any sense for anybody to build a rental. Well, I say that. There were people who did build, but we couldn't make sense of it. And what we did at the time in 2015, 2016, because we believed in the rental product, we bought a whole bunch of condos and created a REIT. So one of the projects that we have is a condo REIT called Central Condo REIT, where we at the time we had 80 something condos. Now we've sold a bunch through COVID, but I think we still have 53 condos in downtown, and we're renting them out and we're getting good rents. But we bought them at really good prices in 2015, 2016. So even with the correction today, we're still way ahead. And that makes sense, but it didn't make sense to build rental buildings. And just bringing it back to the story, I feel like that's reversed. I feel like now, because of CMHC financing, you can build a rental building today with 15% equity. Some people are going with even less, but we think that's the right 85% financing. We think is the right place to be. And condo, if you don't have the pre-sales, you're going to need a lot more equity. And I don't know who's going to build a condo for sale unless something fundamental changes in the market.
So I think you said you've got these two projects in the Vaughan Metro Center. Are they land or are they under construction?
No, they're land.
And they
it's
were
one
designed
site, two towers.
two towers, and they were designed to be what, towers? Over
Condo.
40 or 50 stories?
Yeah. Yeah. Condo towers.
And so you've got the zoning
Yeah.
and you're just sitting on it.
Yeah. It doesn't make sense to sell it at a price that doesn't cover the cost to build it. So until we can get a price that is higher than the cost, it's just going to sit.
So this is the problem that we've got in Toronto right now, isn't it? And this was mentioned numerous times at the Real Estate Forum last week, that there are numerous developers that over the course of the last 5, maybe even 10 years, played what was described as a height and density game, where they were trying to get, higher height and greater density approved because that's what made sense in the pre-construction condo market. But that market, as you've described, is dead and people aren't doing anything. Shouldn't they be doing something? Shouldn't they be either building or shouldn't they be downsizing and building a smaller tower? Like, why are people just stalled? Why is the market just stalled? Why aren't people, pivoting and amending their plans and doing something with those sites?
Well, I think it's not that easy. I think that for a lot of the sites, if your zoning is in place and you have your site plan already, then you've got to go back to the drawing board, and you don't know even if it's going to be feasible what you're adjusting, because right now there's no, like I talked about Vaughan, we have another one in Baby Village that isn't as big, that we can't pre-sell in construction. We can't build because we would have to pre-sell. And there's no pre-con.
Convert Bayview Village to purpose-built rental. Why not?
that's what we're trying to figure out. And we have rental replacement on that site. So the city of Toronto, if you buy an existing site that has some rental units, I think it's if there's more than 4 or 6 rental units, you have to replace the rental. So that brings down the pro forma. We don't mind replacing the rental, but it's got to work. You still have to, make a profit on the development. So that's what we're trying to figure out on that site. I do think that that site is a good candidate to become rental. Um, but one of the things that's key is bringing in a rental guy who knows what they're doing on the site plan. So we don't want to take like condo guys and say, okay, now make it a rental. It's not the same. Um, so
Isn't the real estate development business, condo people can do purposeful rental? Is it really that unique, that different?
yeah, I think it is. I think the suite layouts are different. I think um, the design of it, the thinking of it, the amenity space, the energy efficiency aspect. I think condo guys, as much as we have so many condo partners and we enjoy being involved, they're building for sale and they're building to give someone else the unit for them to take care of in the long run. And in the rental building, they're generally building for the long run. They want to hold and keep it. So they think of things a little bit differently. They might invest in different parts for the longevity and sustainability of the building more than a condo guy will. But really, the layouts, livability, you're not trying to design a layout to get the price down, which is what a lot of condo guys used to do. Design the unit so that you can have a lower price per square foot and lower ticket price so that more investors would want to buy it. And that's what we're seeing today is that there's so many of these smaller units that aren't that livable coming on the market. We always tried to get developers to focus on livability. But in reality, when you make them smaller and smaller, it's harder to have livability in them. And the rental guys are thinking, I'm going to own this for 25 years. So I got to make sure that I can turn over tenants, that it's not just the first guy. When the first guy leaves, it's still a great unit that I can get someone else in. So it's the long-term nature of the business and it is different.
I heard a lot of contrary opinions at the real estate forum last week. I heard CEO of a major purposeful rental company say that you don't need balconies, that Julian balconies are fine, and but you do need swimming pools. And then I heard an architect, one of the leading architects in the city, saying no, 94% of people still want balconies, and you don't need swimming pools. Only a few have swimming pools, only if they're several towers put together, because otherwise you can't justify it. I heard people say that people still want parking, and the reality is Toronto is a car marketplace, particularly if you're not right downtown. I heard other people say no, you don't need parking, particularly as you said, if you got to go below 2 stories below ground, it just doesn't cost justify. I heard people say interior bedrooms are okay, and other people say no, interior bedrooms are a disaster, and you've got to have square layouts with lots of light. What's your sort of sense of things as you're thinking about designing your buildings?
Yeah, I think a lot of those, you have some stuff that's true and some that's not, I guess. I think that you definitely don't need swimming pools in mid-rise buildings. And one of the big things that the renters I think mostly care about is the price. So you want to make sure that balconies, no balconies. I think that they will say in a survey they want a balcony, but if you're faced with 2 units, one is 2,500 a month and one is 2,200 a month, and the 2,200 doesn't have a balcony, I think the 2,200 wins. It's not. People are not spending $300 more a month in rent to get a balcony. So I think that, yes, they would want the balconies, but I don't think that they need them. The parking is the big thing, and it depends where you are. We're building in Kitchener and Grimsby, and we're doing surface parking and even a little bit underground in Grimsby, because in those markets, you absolutely need a car. In Toronto, you don't. And it's interesting. We're building on Vaughan Road, and we're building with very little parking. They're putting like car share in and place for Ubers to come, but not for tenants to have parking spots. And lots of bike parking, but not not car parking. And people are asking us all the time, who's going to live? Like Cedarville neighborhood is lots of families, and you're building family-oriented units, and they're going to need a car, and they're not going to want to live there without a car. And I think today Toronto is very car-centric. We talked about the transit that's coming, that's hopefully going to alleviate some of that because the traffic is so bad that I think that, if it takes 10 minutes to go on the Eglinton LRT to get somewhere versus half an hour to drive somewhere, people will start using transit a little more. Um, but I think ultimately the thing with Vaughan Road, as the example, is next door to where we're building is a small, it's like a 6-story building, and I think they have 45 parking spots, and it's been there for 30 years. And what I heard last was that 10 of those 45 parking spots are rented. So if guys come into our building and they want parking, well, we can get a parking spot next door. On top of that, we're building the Groove condos right across the street. So we have a condo site on one side of Vaughan Road that's almost finished, and we're building a rental on the other side that we haven't started yet. The condo site, I know for sure we have parking spots in the condo site that aren't sold. So I would love to broker a deal where, the renters in our rental building want parking, they could take it from our condo site. I think the reality is that we've built a lot of parking over the last 30 years that isn't being used in different areas. And if anyone is, I'm not a futurist, but I invest in Tesla as an example, and I believe in some of the things that they're doing there with the self-driving cars, and with the idea that, in the future you could buy a Tesla for 30, 40K, and then when you're not using it, you could send it out on the road to go drive other people around. So you won't need to park it overnight because it's going to be working for you and making you money. I think if that's a realistic thing, I think everybody's going to have a car like that. How far away is that? 5 years, probably not. 10, 15, maybe. But again, when you build rental buildings, you've got to build them with a 20 plus year view. And I think in 20 plus years, we won't have the same amount of car ownership. It's going to be a lot more Uber, self-driving car, that kind of thing. And you won't need to store your cars in your buildings anymore. And like I said, it's a future thing. It's 20 years out. People might think I'm crazy talking about it now. In the short term, we definitely see being very car centric in Toronto. But in the long term, I think that's going to go away.
So I had a real estate agent who told me no one's going to take their kid to hockey practice on transit or in an Uber. Are they just ostrich stuck in the head in sand and not seeing the future, or is that the reality?
I guess it depends how old their kids are. My 15-year-old in had practices, hockey practices in May and June at the rinks, and it was early on Monday afternoons, and there was no way I was going to drive him there through the city. And him and his buddy took the subway. So, I have a real life example of my son taking the subway to hockey practice. I definitely think that's not common. I do see Ubers as a thing too. But it's hard to envision it today. You don't want to put your kid in an Uber for sure. But Uber's come out with Uber Teen. But just the whole self-driving car concept is hard to envision. And I think if you go to places like where they're using them in Texas and I think Phoenix and California, they're on the road already and they're driving around. And yeah, in 10 years, if self-driving cars are here, would you have your self-driving car pick up your kid to take them to hockey practice? Probably. Would you need to park that car in your garage overnight? Probably not. But again, it's hard for people to get their head around something that's so future-based.
So, last question. The sense of the real estate forum was that everyone thought that 2025 would be the year that things would turn, and it didn't turn out to be that way. But then they said, well, maybe 2026. Actually, they didn't say maybe. They said 2026 is the year that things are going to turn. What would you say if you were one of the closing keynote speakers at the real estate forum? Is 2026 the year, or is it 2029?
Yeah, I don't think it's 26. I mean, we used to say survive to 25. That was a saying that we had in 23 and 24. And I think what we didn't realize was the Donald Trump effect. So I think that's really the Donald Trump effect is really the impact in 25, the uncertainty that we have, the potential recession. I think that's what's holding people back. I think that's the biggest issue today. Interest rates have come down, so that's not an issue anymore. Will 26 be the recovery? It depends on what markets. I think office markets are coming back. So that's where people are maybe optimistic. I don't think the pre-con condo market is coming back in 26 or 27 just because we have the supply overhang. So I think it'll be 28 before those pre-con investors come back and the condo market starts to pick up again. I'd love to be more optimistic that it's going to happen sooner, but I think the only way it happens sooner is a combination of things that could actually come to fruition. One is we come up with a free trade agreement with the US that works for us and we don't have this tariff issue anymore. That would be a big one that we could have certainty going forward. Obviously, the federal government is making lots of investments. And so if they can get employment up, even with all the construction employment that we expect to fall off when all these condos are finished, if the government can somehow figure out how to keep employment at a reasonable level, that will be good. And that's, their infrastructure projects that they're planning. And then if they really want to stimulate the condo market, they've got some levers with the development charges and the HST. So, there's other ones too that they have in the States, like the 1031 exchange that could help stimulate investment in development. That they're not really talking about right now, but the MERB program was one that the Carney government talked about in their platform leading up to the election that could stimulate purpose-built rental, but they're not, they didn't bring it forward in the budget, so maybe in the new year. But I think without some government intervention and some help on the U.S. issue, I don't think that we're going to be coming back in 26.
Devon Cranson, Cranson Capital, really appreciate it. This has been an excellent overview of Cranson Capital, yourself, and the real estate development industry in the Greater Toronto area. Really appreciate it. Thanks so much.
Thanks, Brian. Really appreciate you having me on, and hopefully your audience got some good insight.
That's our show for tonight, everybody. Thank you for joining. I remind you I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online at www.saga960am.ca. All my podcasts and videos go up on my website, briancrombie.com, on social media, on YouTube, on podcast servers as soon as the radio show gets broadcast to air. Wow, 2026 is going to be interesting to see whether Mr. Cranson is right or some of the other prognosticators are right or whether we're going to be bumping along for another year or two. Stay tuned. Good night.